Hi everyone, good morning. My name's Luke. I'll be your host today for the What Taxes Do I Pay webinar. This is purely for limited company directors, and today we're just going to discuss some very basic setups and things that you need to consider if and when you do form your own limited company. So I'm a quality coach here, and I've worked at Crunch for quite some time now. I currently train all of the new and existing staff. So it'd be good to give you guys the same information that I pass on to staff members here so that we can assist you in forming and considering forming your own companies. So today we're going to discuss a few of the taxes. If you've got any questions, please feel free to ask and we'll go through them at the end as well. And anything that we can't answer here and now, I will follow up with emails later. Okay, so the first thing that we should go through here is what taxes do you need to pay? Okay, so for Crunch, this is our bread and butter. We've helped over 10,000 people in similar situations as yourselves. You know, maybe some of you have done this in the past, maybe it's completely new to you, and you just need a bit of guidance and support on where to go and what to do. So some useful resources, first of all, that can really help if you want to read at your own leisure and your own time, is we do have free knowledge guides and articles on our website. We promote something called Crunch Chorus, which is accessible for everybody. There's loads of tools, loads of information on there, which I'd highly recommend having a look at, and then maybe chucking it in your bookmarks as well for future reference. So what we provide here is personal accounting, as it says. So we look after sole traders, self-employed. We also help with self-assessments as well. Limited company accounting is where we really strive for contractors, consultants, freelancers, and as I say, limited companies in general. We also now have a new package for small and growing businesses, whereby, as you can see, you get your own personal dedicated accountant, bookkeeper, and so on. But these are just some of the things that we can help and support with. So if you do want to find out any more info, then please don't hesitate on calling at any point. So some of you are probably wondering, where do you start? So 101 will be consider what type of company you'd like to set up. This can be a limited, an LLP, or a PLC. Now, a limited company for ourselves at Crunch is by far the most popular. A lot of people spend a lot of time thinking about a unique company name, and I have to admit it can be important because that's what people remember you by. You need to supply certain bits of information to your company's house if you're going to form this yourself, and it really is quite simple. Or if you'd rather give it to somebody else, you can use a formation agent. Now, this is something that Crunch actually does for a lot of our clients. So if you are umming and erring about what to do, where you need to go, what registrations and things, then again, give us a call, or you can find lots of material online. Now, the incorporation process itself does mean that you need to have quite a lot ready at your fingertips before going through this process. So you need to consider things like trading activities, what sector you're going to be in, whether you're going to have staff, whether you're going to have multiple directors or shareholders, for example, as well. So there's quite a few things that you do need to think about, and it can be quite tough on your own. That's where we can help, or as I've said, you can go to Crunch Chorus and you will find a lot of information on there as well. Now, those are the setup. Now, in terms of taxes, corporation tax is the big one. So this is placed at 19% in the 1920 year. That's up to a turnover of 1.5 million. Once you start turning over that sort of money, the tax does increase, and it's a tax that's applied to all limited company profits as well. So this is after things like salaries, your deductions from expenses have been taken out of your company's income, but before your dividends are withdrawn. So the easiest way to explain corporation tax and break this down is if you take your total gross, so all of your revenue, all of your income, you then deduct all of your expenses, all of your outgoings, and what you're left with then is the amount that can be taxed. Okay, so as long as there is profit in the business after your deductions, that's when corporation tax applies. Now, in terms of filing for corporation tax and HMRC forms, all limited companies are required to submit a form called a CT 600, so a corporation tax 600 document. Now, this does contain details of all of your company's income minus those tax allowances and expenses I mentioned earlier. Now, you may think that that's enough, for HMRC, but it's not, I'm afraid. Corporation tax, the CT600, is just one document. You do also need to consider that Companies House as well will need to receive the full company accounts, which is then uploaded onto their public register for full transparency purposes. Now, there is certain circumstances where you can have something called abbreviated accounts, but that does need to be applied for through Companies House, and they will give you something called an exemption in that respect. But that is basically it for corporation tax. So the easiest way to look at it is take your total minus your expenses. What you're left with then is your profit, and that is what the tax will be applied to. Okay. Now, paying it, obviously nobody likes paying the corporation tax, understandably, but a few rules have come into play. So you can no longer pay at a post office. So you have to actually consider setting up what's called a government gateway ID, where this will allow you to access a portal on HMRC's online account. You can enter the business details for your company, things like corporation tax numbers, for example, your company's registration number. And I would actually highly recommend doing this regardless anyway. The main reason being is that you can constantly check your tax liabilities. You can always check to make sure that you've actually paid it or not. I can appreciate once in a year, among all the other things that you may have to balance and juggle as well, is going to be quite tough. But it's a really good idea just to keep yourself in the loop with where you're at and where your tax position currently lies. They have modernized their system, in fact, so you can now choose to pay via online. You can call them if you want to, or you can set up direct debits with them as well. So that can either be for your debit card, or they will allow you to pay for your tax on the company's credit card. The final point here is that you absolutely cannot use a personal credit card, and I cannot reiterate that enough. Unfortunately, if you do, the likelihood is they're just going to send you all of that money back, at which point you'll obviously have the peace of mind thinking that it's all been paid for, but you may get the entirety back and then have to resend it to them again. So just try and avoid that problem as best you can, and only use the company's banking accounts to pay for these taxes. The next thing is that any corporation tax you owe has to be paid by 9 months and 1 day after your company's accounting periods end. So that's known as your year end in the accounting world. And just if I can give you an example, what that means is if my company's year, let's say for an easy example, is between January and December, so the 1st of January to the 31st of December, my year-end accounts themselves will be due with HMRC in September of the following year, and I then have to pay that tax on the 1st of October. Okay, now you do have an option to pay at any time, bearing in mind, all right? If you get your accounts done early and that's all filed and both the CT600 and the full accounts have been uploaded, by all means, don't wait. There's no reason to. In actual fact, if you do pay this early anyhow, HMRC may actually give you some interest. So they might knock a little bit off of your bill as well, okay? What's more is it's just easier to get it done as soon as possible so that you're not fined as well. Obviously, nobody likes the fines and penalties. So if you've got your stuff in order, you've got your accounts filed, get it out the way and then carry on with the rest of your business year as you should. The final point on here as well that I do want to make super clear is the payment reference number. I can't actually stress enough how important this is, and I can appreciate that maybe some communication from HMRC doesn't make it as obvious as it potentially should be. The payment reference number is a specific number that you need to use if you're going to make payment online, okay? Now that's usually a mixture of your corporation tax number, which is about 10 digits long, and then you'll often get about 5 or 6 extra characters and letters on the end of that, which is the payment reference. Now, the problem with this is if you do not use the relevant payment reference number for the correct accounting period, whilst you may have actually paid this to HMRC, unfortunately, they will not just look at it and then allocate it to the correct period. So again, you're going to run that risk then of HMRC actually paying you all of your tax money back again, you all under the while thinking that it's all done and dusted. You get it through the post. And sometimes there can be an illusion actually that it's a rebate or a repayment as well, which can of course cause more problems. So again, I can't stress enough, just make sure you're using the relevant payment reference numbers for the correct accounting periods. And quite often, if I can give you a little tip early on, they're supposed just to go chronologically, so for instance, if it's your first year, the payment reference will often end in 01. Once you enter the second year, it will end in 02, so on and so on. However, in my experience, I have seen sometimes chronological order doesn't seem to apply in some instances with HMRC. So again, just double, triple check that you're using the correct reference number so that you can avoid any problems and any delays, and more importantly, fines as well. Reducing corporation tax bill. Now, this is always a point of interest for a lot of people. 3 very simple points. Claim all of your allowable expenses. Now, the golden rule with what we would deem allowable expenses is simply, is this wholly and solely for business purposes? If so, yes, of course, claim it. So things like travel, for instance, food even as well whilst you're working, by all means, claim as much as that as you can, as long as it's within reason. And I'm talking about not going to the Ritz for a 3-course dinner. It is just your basic meals throughout the day whilst you work. Secondly, and this might seem almost like a pointless point, I guess, to make, just don't forget to pay yourself. A lot of people don't seem to realize that actually your salary that you pay out every single month is an allowable expense and therefore reduces your tax bill. So the easiest way that I break this down is, if they are allowable expenses and they are reducing your profits, you know, if you're spending that money out of your company's income, you can't be taxed on that money. Okay, so as I mentioned earlier, only the profit that remains after those deductions can HMRC tax you on. Okay, and the final point, as I briefly mentioned earlier, actually surprise HMRC, pay it early and they will owe you interest as well. Okay, any questions on this particular subject, by the way, please feel free to ask. I'm more than happy to answer as much as I can if you do have queries on corporation taxes, reducing it, how it's calculated and so on. So we'll move on from this section for the time being. Next up is your income tax. Now, income tax, I think we're all aware of what it is, but we may not necessarily understand it in full. A lot of us that have worked as an employee, like myself currently at the moment, up until I joined Crunch, I had no idea what it meant. I would quite often get my pay slip, I'd look at it at the end of the month, I'd see that I've had deductions, it would make me a little bit sad, but I'd never really questioned it and I just carried on as it was. Now, income tax itself is only paid on certain types of income that you personally receive, like a salary, for example. Okay, income tax is set at 20%, right? And this is based on a threshold of a PAYE allowance. Okay, now you have actually got 2 different thresholds here for salaries. You have a national insurance threshold and you also have an income tax threshold. Now, the national insurance as it's set at the moment is £8,632 a year. That's completely tax-free, that salary. You will not pay anything on it whatsoever. The moment you go over this point though, 13.8% will start to apply. Okay, and then once you've reached the PAYE allowance, which is currently £12,500 for this year, for the 1920, you will also then start to pay income tax on anything over this amount as well. Okay, now it can also be payable, as it says, on things like the sale of assets, okay, such as share disposals, or if you have any properties as well, which are not your main residence. This is something called capital gains. Okay, now this can be quite complicated. So by all means, I'm not going to go into this now, but please feel free to ask as much as you'd like about capital gains at the end, and we will come back to you and we'll put an accountant in touch if needs be as well. So paying it. So if you're a limited company director and draw a salary above the personal allowance, like I mentioned earlier, so that's the 12,500, the income tax is actually deducted at source. So as I said, for example, my pay slip, I get paid at the end of the month. I can see those deductions come off that pay slip, but I've actually done nothing with it at all. Okay, my employers have actually calculated and paid that to HMRC for me. Okay, so all limited companies need to be aware that even if you're not going to take a salary through your limited company as well, you have to have a PAYE scheme. That's actually mandatory. There's no option about that at all. The reason being is that HMRC requires something called real-time information. So every single month you have to report to HMRC whether you are or aren't taking a salary, full stop. So it makes no difference at all. You have to consider a PAYE scheme and set one up as soon as possible. Now, dividends are slightly different in the respect of the way that they're taxed, okay? So you don't get your dividends taxed at source. You only report this to HMRC once per year, and that's what we would call the self-assessment season, which ends in January, okay? Now, all of the tax is accounted for between the 6th of April and the 5th of April, okay? You then need to subsequently pay any of the tax that's owed for that period in January, okay? Now, all company directors have to do this. And again, it may sound silly, but even if, and probably extremely unlikely, but even if you've not taken any salary, any dividends whatsoever from that limited company, you still need to report this to HMRC. They just want the paperwork to see that you've not actually drawn money, or if you have drawn money. Okay, shareholders as well do also need to consider this. I'm aware that this point isn't on this slide, but do also consider your shareholders, okay? Because if they are taking dividends, for instance, that does not get reported each month, so therefore they will have to tell HMRC as well at the end of January every single year, okay? Now, there is something that you should all be aware of, and this is actually quite a recent thing. And I say recent, it's been a few years, but in the grand scheme of things, it is quite fresh in HMRC's operations. So they now run something called a payment on accounts. And this is for most people that do operate through limited companies and have their tax deducted through self-assessments. So even if, for example, you're self-employed and you don't have a limited company, this will still apply on your self-assessment. So the general rule is, if more than 80% of your income gets taxed through PAYE, it's not going to apply, okay? So if you are having an employee's pay slip, you are getting your tax deducted at source, it's not going to matter to you whatsoever, okay? However, if your self-assessment tax bill, so this is the money that you owe HMRC, is more than £1,000, so £1,000 or over, then a payment on account does apply. So to give you an example, let's say that I have a self-assessment bill of £1,000, okay? This means that in January, I will owe them £1,000 for that actual tax, okay? However, I would also need to consider that I need to pay my first payment on account at the same time, which is going to be half of that tax owed. So the reality is I need to pay them £1,500 in January. And then come July on the 31st, I make my secondary payment on account, which will be the other £500. Now, this can seem a little bit strange, and I will admit in the first year, it can somewhat cause a little bit of confusion and maybe some concerns financially, okay? Unfortunately, it's very much like a revolving door of money with regards to HMRC. So what will happen is your £1,000 you've paid, that's cleared. That £1,000 that you have now potentially, we would see it as credit in that respect. By July, you've got £1,000 sitting on the account just waiting as credit towards your next bill. So let's say come next year, my bill is exactly the same. I owe another £1,000 again. I've currently got £1,000 sitting as credit in this kitty, or wherever it is that HMRC decide to keep this. That £1,000 will get absorbed by my new tax bill, okay? However, again, we go back to that same rule of £1,000 or over. My tax bill technically is £1,000. I have the £1,000 credit, so I don't need to pay that. That's going to be absorbed. But I do need to pay another £500 in January, and then a secondary one in July also. So as you can see, it's almost like a merry-go-round, okay? You're always, when you start, going to have this certain scenario where you have to credit the account, but as you can probably tell already, it's often the first year that can cause the most trouble, okay? If you want to find out more about this, or if you're in a situation like this at the moment and you find yourself having to pay your payment on account, call HMRC, okay? They will be willing to set up plans and things if completely necessary. You can also explain your situation to them, because perhaps maybe you're not going to be working as a limited company in the years to come, at which point you're going to have your tax deducted at source. So none of this applies at all at that stage. Again, though, any questions on this, please feel free to fire them over at the end, and I'll get to as many as I can. National insurance. Now, we spoke about this a little bit, okay? Now, national insurance is obviously important because it builds up state pension qualifications and the entitlements, and of course more socially accepted is the public services as well, okay? Now, you're only required to pay national insurance if you're 16 or over, okay, and are making a profit equal to or above the £8,632 annually. Now, this does break down to £719.33 per month, just as an FYI, if you're wondering what to pay monthly instead. Now, national insurance, I think a lot of people get confused with, because there's an illusion that if you don't pay the national insurance, then you don't qualify for the state pension, for instance. There is another limit called a lower earners limit that you need to consider. It's roughly, I believe, about 6,300 odd. Don't quote me on that, but it's around about that figure. So as long as you're taking above this lower earners limit, or an LEL, as HMRC call it, strangely, although you're not paying the national insurance contribution if you only take the primary threshold of 8,632, because you take more than the LEL, HMRC are actually going to contribute towards your national insurance for you, even if you don't. Okay, so that qualification is not in jeopardy. Okay, as long as you take above the lower earnings limit, you will still be entitled to a state pension that HMRC contribute towards, which is always a plus. Now, as with income tax, if you're a limited company director, as it says, any national insurance also gets deducted via your pay slips as well. Okay, so similarly to mine, I will be having income tax and national insurance deducted, but on the pay slips they'll show as separate lines, so you'll see the income tax deduction as well as the national insurance underneath as well. VAT. Now, I have to admit, this does confuse quite a lot of people, because I'll be totally honest, it is extremely confusing. But actually, if I can help a lot of you break this down and make it really simple, hopefully a lot of you will realize it's not as complicated as what we're all led to believe. Now, VAT, I think a lot of us are aware of maybe what it is and the fact that we all have to pay it. But again, very much like PAYE, for example, we don't really question it a lot of the time. You go into a store or something, you buy it, and you just walk away with it, and that's it. Now, VAT is added to almost all goods and services. So goods being things that you buy, for example, your expenses in that case, things like your subscriptions, any services like softwares, licenses, etc. And your services is where you apply the VAT. So you will actually add 20% on top of your costs. Now, as an example, if I'm VAT registered and I want to charge someone £1,000 for a service, I actually have to charge them £1,200 instead. So the £1,000 for my work and the £200 VAT element. Now, businesses do not automatically get registered for VAT, because there is you get an option, basically it's voluntary up until £85,000. Okay. Now, it is worth considering being VAT registered, even if you're not going to be turning over that sort of money. There can be a multiple list of reasons, and I'm not going to go through them all because I'll keep you here all day. However, the way to look at it is if a lot of your expenses have VAT applied on them, so things like goods, so subscription costs, licenses, legal fees, anything like that, you're going to be paying the VAT anyway. All right. If you do decide to get VAT registered, there is every chance that you can actually reclaim all of that VAT back that you're paying. Okay. Now, for more information about VAT, you can either visit the HMRC's website, give us a call, check out that Crunch Chorus Resource Centre as well. By all means, there's lots and lots of info on there. One thing you do need to consider, though, is that actually once you are registered, you have to, by law, charge VAT to your clients or customers. So what I mean by this is you have something called an effective date of registration. Okay. So let's say you formed a business today. Okay, you may not necessarily start being VAT registered from today. Let's say 6 months pass and you do decide VAT registration is actually going to be beneficial. At that 6 month mark, you then have to start charging it. So that's what the effective date of registration means. Okay, so prior, if I was using that same example, I was only charging £1,000 for the service. There was no VAT that I could add because I'm not VAT registered. However, 6 months have passed. I now am. I have to add that extra 20%, so then my invoice becomes £1,200. Okay. Now, the way it works is you've got two different schemes. Okay, so you've got a standard VAT scheme. You also have a flat rate VAT scheme. Now, the standard one's the original VAT scheme. That's been operating for years. It used to be something called purchase tax before it became VAT anyway, and this is just the bog standard you put 20% on your invoices, but you also reclaim your 20% VAT back on your business expenses. Okay, this then has an effect what we would call offsetting. Okay, so as an example, if I had to pay HMRC £1,000 because of the VAT that I've charged to my customers, yet when I look at my expenses, I have £500 that I'm claiming back on those items, all I actually do is deduct the £500 that I'm claiming against what I'm paying, and I give HMRC the difference. Okay, the same can be said if actually my expenses outweigh the amount that I'm paying HMRC. So let's say I only owed them £500, but actually the VAT I'm claiming is £1,000. Therefore, HMRC owe me £500 at this point. Okay. Now, the flat rate VAT works very, very differently, and this, I believe, can be quite confusing, understandably. The difference with flat rate reclaims is that you are only able to claim back fixed assets that are valued £2,000, including the VAT, so £1,600 without it, for example, and you keep a percentage basically as profit, so you repay them a lower amount. So this is based on something called a trading sector. So depending on what you're doing, let's say if you're in the IT sector, you charge 20% on your invoice, but you only end up paying HMRC 14.5% back. That remaining percentage that's left over, you generate something called flat rate income at this point. So that in turn is then boosting your profits. Okay, now I'm not going to go any further into that just because, as I say, it can be quite complicated. There are a lot of rules and regulations, especially between the two schemes as well. So by all means, please give us a call, give us a shout, have a look at the resources online should you want or need any further info on either of those schemes. Paying it is done quarterly. Okay, now there are some businesses that do operate an annual VAT scheme. Personally, I would probably recommend looking at quarterly because it gives you a much clearer picture of what it is that you're doing, what sort of money you've got left over. Your financial planning can be a bit clearer if you're looking to project in the future as well. You do need to consider, if you do go on quarterly, that you will basically be paying this every 3 months. Okay, now if you have a VAT period that's between January and March, HMRC will actually give you a month and 7 days to get it filed and paid after that period ends. Okay, so in this scenario, if it was the 1st of Jan to the end of March, I would actually have to pay this by the 7th of May. Okay, so I have to get it filed at the end of April and then pay the VAT 7 days later. Of course, you can always do it early though. Okay, now since the 1st of April this year, so this is very, very new, all VAT registered businesses now need to use the Making Tax Digital compatible software. Now, as it says, Crunch does this without a hitch. Actually, we've been doing this for years and years, so we're way ahead of the curve in that respect. There are a lot of competitors out there, of course, so we're not the only ones these days, although we were the original, but they have to ensure that they are all compatible with Making Tax Digital. Now, this means that actually all of your filing now needs to be done online through something that they call API connectors. Okay, so this is where you have a bit of software that is directly linked with HMRC's filing system, so it can be automated. And actually, it's probably going to do everybody a favor because there's none of this manual, paperwork, sending it off, waiting for it all to be signed off, etc. anymore. So it can have its benefit in that respect. If you are VAT registered, again, it's very similar to what I was mentioning about the salary scenario. Yeah, HMRC just wants to be kept in the loop. So even if you do not have any VAT to pay or reclaim for that matter, you still have to file that with them every 3 months, even if, albeit, you're simply filing pretty much a blank document with zeros on it. They just want to see it as confirmation. Okay. So a little bit more about the flat rate scheme on this one, just because it's the newer scheme of the two. And just to give you a little bit of a history, if you're interested at all, the flat rate scheme was introduced in the 90s. Okay, so the reason for this is that when we had the technological boom with the IT, the internet, for example, as well, all of these new creative businesses started popping out of the woodwork. So web designers, UX designers, software, etc., etc. HMRC therefore needed to incentivize these types of businesses to register for VAT. As I mentioned, standard's great if you've got lots of expenses that have VAT applied because you can claim it all back. However, within the IT industry, it's very unlikely that you're going to be buying a lot of expenses. So these are what we would call non-traditional businesses. You may every now and then, once in a blue moon, buy a laptop, for example, maybe upgrade your hardware, okay? But it didn't really warrant a lot of the IT companies being on standard, because you would simply end up just paying and collecting money for HMRC. So this scheme was introduced in the 90s, so that if your business has a turnover below 150 grand, it's probably going to be beneficial to consider registering for flat rate if you're in the IT industry. Now, it can be really, really simple. Okay, the reporting is actually a little bit easier, meaning that there's no need to record VAT for individual purchases and sales. Doing this can also result in an increase in your company's income. As I mentioned just a moment ago, it's called flat rate income. So whilst you charge 20% on your invoices, you only actually pay HMRC a lower percent back, depending on your trading activity. Okay. Now, business rates, if you run a business from a non-domestic property, like an office, like it says, shop or a factory, you are likely going to have to pay business rates. Now, you will get these business rate bills from your local authority in February or March each year, okay? And that's going to be for the new tax year following the 1st of April, okay? You need to be really careful with this as well. So please keep your eyes on any sort of documents, post, anything like that that you receive from your local authorities. If it's got your business name on it, especially as well, because any details of how to pay do get included on that, okay? And they will give you the flexibility of opting to pay in 12 monthly installments if needs be as well. Now, Crunch Chorus, a little bit more info on this. It's a free community by all means, so you don't have to pay or anything whatsoever. You just create an account, log in. It's got a lot of useful resources, including things like this webinar. You'll have all previous webinars uploaded on there as well. So if you do want to go back and have points of references, feel free. It provides things like invoicing software, document templates, if you need to have a look at how to produce them, maybe if you want to make up your own, if you are a creative mind. We also organise things like regular meetups and social events. That could be simply things like going to the pub, having a pint, and maybe having a chat. And the other thing as well, which probably is of more interest to a lot of people, I'll be honest, is the discounts that they get on products and services as well. Okay, so do check that out. It's incredibly helpful. And as I say, you can always give us a call as well. You know, we're always open to a discussion, so don't hesitate on calling, even if it's just putting the feelers out there to get some info or some understanding of where you need to start or where you need to go. Okay. So some useful links. As I say, this webinar is going to go online. So these links here are completely accessible to all. So you can get guides like small business taxes, what you need to know, how to go about setting up a limited company, for instance, as well. Your responsibilities, how to reduce your taxes, so on and so on. Okay, so this is just a handful of some of those materials that you may get online. Now, that is us for today's webinar. So hopefully it's given you guys some idea of where to go, where to start, what to consider as well when you're doing this. I'm going to have a very, very quick look. It looks like some of you have actually sent in some questions. Oh, good. Maybe it's about 18 I've got here. So let's have a quick look at those. Okay, here we go. What's this? So I've got a question here from Joanne. Do you need all receipts for food? Good question. Because, I mean, it kind of goes back hand in hand with the making tax digital, for example, as well. So not only now do HMRC want all of the filing done electronically, paper receipts are actually going to become a thing of the past as well. I mean, for our own benefit, I have to admit, I mean, if you're anything like me, you've kept a receipt for a couple of weeks, take it out the wallet and the ink's already gone. I would actually strongly recommend starting to photo. So just use your phone, scan it, whatever way you want to do this. Digital receipts are absolutely fine, okay? What's more, then once you've got that copy, you can get rid of the old paper one, shred it, do what you will with it at that point. Now, I would strongly recommend keeping a folder on your computer if you're going to do this that is purely dedicated to your receipts, okay? Some software as well, Joanne, if you are using someone like Crunch or any other place out there as well, will sometimes actually have the capability of you uploading your digital receipt straight into the software. So actually keeping that folder on your computer may not even be a necessity at all either, okay? So hopefully that's helped. Like I say, digital copies are, in my opinion, by far easier as well. Plus it doesn't take up all the room in your wallet or your purse, which is always a plus. So we've got another question here from Peter, let's have a look here, Peter. So is there a rule of thumb relationship between turnover and expenses which would reduce corporation tax? I mean, turnover itself, the way to look at this is everything in its entirety. Okay, so you've got your whole income, all of the money that's coming into the business's accounts, whether you've got multiple bank accounts, it makes no difference at all. It's just all the money that's being generated. Now, your expenses, because that's money that's going out of the business account, HMRC can only, by their own definition, tax you on profit of your business. Okay, so if you have, even if you've got a huge turnover, let's say of £100,000, yeah, if you're then spending £10,000 throughout the year of that on expenses, maybe salaries, as I mentioned earlier, you're only going to have the bit that remains seen as profit. So that's when your 19% is going to apply. There's various other ways that you can also look to reduce your corporation tax. It's not just through expenses, bearing in mind. Things like pension contributions, for instance, is another clear winner. You're able to set up a private personal pension and start taking money out of the business into your own personal pension. Therefore, that's seen as a deduction on your income, and that is an allowable expense as well. Okay. Now that is actually probably one of the biggest ways of helping reduce corporation tax. But as I say, the general rule, golden rule of thumb is if it is wholly and exclusively for business purposes, it will be deemed an allowable expense, and therefore you will get corporation tax deducted as well. I think, wow, there's actually quite a few additional questions on here, which is awesome, which is really great. However, I think due to the number of them, it may actually be beneficial for me to take a little step back, have a look at these individually, and then I can respond in kind to each of you on here. Now, as I say, there's a lot of information online. Please feel free to get in touch as and when you need to. I really hope that this has helped some of you get more informed and actually maybe even consider starting your own limited company if you have been umming and erring for quite some time. I do want to say thank you very much for all of your attendance. It's been an absolute pleasure. As I say, please feel free to get in touch, and I very much look forward to the next one. Thank you.